Hello, everyone. We'll wait just a minute or a few seconds here while our participant numbers trickle back up. Great. Welcome, everyone, to this office hours. Today's topic, legal considerations in debt financing to buy your business. My name is Will Smith. I'm the host of the podcast, Acquiring Minds. And attorneys James David Williams and Bill Barlow are going to host our session today. Bill and James David are, of course, the partners in Barlow and Williams, a practice that specializes in small business M&A. They see tons of deals. They're really at the front lines. Their focus is helping searchers and sponsors like you all do your deals safely and to your advantage. And they also represent sellers, so they understand well both sides of what goes into the sale of a business. This is their 8th office hours with Acquiring Minds, and I strongly encourage you to go back and watch their other sessions, all of which have been recorded, all of which are available on the Acquiring Minds website. I'm going to provide links here in a moment to all of those. Couple items before we begin. The way we run this, as always, Bill and James David give their presentation on the legal considerations in debt financing, and then we'll do Q&A. To ask a question, use the Q&A function button of Zoom. That's not chat. That's not raise your hand. There's a Q&A button, which you probably don't usually see because it's only available in webinar format. Also, sometimes a question will come in that's very detailed, very in the weeds, very particular to a live deal. Difficult to ask those in time, so we tend not to pick those, but don't not ask it because James, David, and Bill can follow up with you after the fact to answer the question. Just make sure that you're not logged in anonymously because then they can't follow up with you. So feel free to ask those hairy questions. Just make sure you are not logged in anonymously. We are recording the session. There will be a link sent out to this recording and the slides here in the next day or two. And those links that I mentioned, first, connect with Bill and James David on social. There is LinkedIn for both of them. There are their direct email addresses. There's the link to their website. So do that. And here are all of those office hours that they have done, those previous 7, all right there. So you can really see what a body of knowledge and information they've produced for you. Okay, let's now hear from them directly. Bill, James, David, over to you guys.
Great. Thank you so much, Will. And one thing we'll reiterate is we do actually answer all of those questions that come in, so do feel free to ask them. So the purpose of this presentation is really to help you understand common issues we see searchers, whether it's, doing SBA loans or doing an independent sponsor search, issues that they have when they are trying to structure their debt financing. And so that you can avoid some of the common pitfalls and also understand what is ahead of you as you're using debt financing in your deal. So it'll be broken up. The first part, we're going to talk about SBA financing, and then we're going to switch over and talk about more traditional financing, which you might see in slightly larger deals.
So first, we'll talk about some common issues in SBA financing. And as you'll notice, just bullet points, not a lot of text. So I like it when people listen instead of read on these webinars. So the rules with SBA financing can get very technical, right? There's something very important called a debt service coverage ratio, or DSCR. That lenders will have. We're not getting into those technicalities necessarily because that can vary by lender, but just know that there's all sorts of spreadsheets and modeling and math that goes into these also. We're going to talk a little bit more about conceptual things. So the first thing is the issue of a standby period. Now, what a standby period means is that, and this is relative to your seller note. So this is not the SBA loan. So this is the seller note in a transaction involving SBA financing. A standby period means that no payments are being made under the note. It's possible that it could be a full standby, so that also no interest is accruing, or it could be a partial standby, which is just interest only. Where the standby period can become very important is when you need it to count, need a portion of the seller note to count towards the equity injection, because there can be very particular requirements about how long the standby period is in order for that to occur.
And where this becomes, and just taking a step back, so when you're financing a deal, let's say you're financing for $1 million, you might have, 10% seller financing, so a note for $100,000, and then the remainder comes from a combination of equity financing and the SBA loan. So it's very common to have that seller note. But one thing that sellers often feel a little bit anxious about is the term of the note. So often SBA lenders like the seller note to be for the same period as the term of the SBA loan, which is 10 years. Many sellers prefer not to have a 10-year seller note outstanding. And so some lenders are comfortable with doing what's called balloon payments. So basically that means that the payments are amortized over 10 years as if you were paying it off on a 10-year schedule. But at the end of year 5, you make a balloon payment of all the remaining principal that is due, so that effectively the seller gets repaid at the end of year 5. Different lenders have different amounts of comfort with different terms. So this is something you want to talk very closely about, especially if your seller is very concerned about the terms of their seller note. Talk with your lender, because different lenders will be willing to do different things.
And when it comes to seller held licenses, we're talking about trades businesses here. Lenders will also have different sorts of issues or concerns and requirements around this. Right? It could be that the lender is going to be okay with a succession plan for you to obtain the license, or for other key employees in the business to have it. It could be that you end up needing to keep the seller with some equity in the business post-closing, if the seller is the license holder. And different lenders have different rules even about what percentage equity ownership the seller would need to maintain post-closing, right? So, but that can dictate, something like that, and making it work for your lender can dictate the entire structure of the transaction.
Another thing you should be aware of, probably one of the most important things, is the personal guarantee. So when you sign an SBA loan, and if there's a default, the SBA can go after any and all of your personal assets. And so obviously that's a very important financial burden, because it means that you can't just walk away from the loan and just continue on your life as normal. You will be put into default. You will be put potentially into personal bankruptcy. So it's a big deal, and you should know that is, that is there. And there are also sometimes times when they require, because it's community property or whatever, want to have a spousal guarantee. And that's obviously something your spouse might worry about, or the home that you jointly own. So just know that is a big issue, and that's something you should know about. And if you need to talk about it with your spouse, you should also be talking about that as well.
And the personal guarantee applies if you have a 20% ownership stake. So anyone with a 20% beneficial ownership stake post-closing will be asked to sign the personal guarantee.
Guys, can I hop in on personal guarantee? People always want to know, we're already getting some questions. What can be protected from a personal guarantee, if anything? Yeah. real estate, retirement accounts. I know we're already getting those questions. So do we want to do that now or later or what?
Yeah,
I mean, the short answer is not a lot, but there are a few states where your primary residence will be shielded. Florida, for example, has a homestead provision in, I think, the state constitution that shields a primary residence from bankruptcy. So that wouldn't be impacted by this. Bill,
Yeah, the other thing is that certain times you can put items into trust, especially this is the case if you have significant real estate holdings that you want to put into trust. But keep in mind that not all trusts will protect you in that way. And so this is something where if you do have significant assets, you're going to want to talk with a trust and estates attorney to do that. One other thing I'll just mention here is that if you have life insurance, you have to be very careful about the life insurance because depending on your policy, the life insurance, if that policy is triggered, might pay into your estate, which then would be subject to the personal guarantee. And so this could be an issue if you die and your wife and children are looking to use that money for their own living, and now it's gotten grabbed into the personal guarantee and not subject to that. So sometimes you set up a separate trust specifically for the life insurance as an example. So depending on your situation, there's different things you can do, but just know that this is something that has to be structured beforehand. Because if you start putting assets into the trust after the guarantee, that might fall afoul of their rules and might not be, fully respected.
And two more cases we're getting questions about, guys. Retirement accounts.
Yeah, I think that if that's in the name in your personal name, I believe that that's wrapped up in the personal guarantee. I would have to confirm with, an SBA expert on that particular issue, but I believe that that's all roped in.
And what about a spouse's assets? Say the house is in the spouse's name, for example.
It's going to depend on the state you're in and how marital property is treated. I think because different states have different regimes for that. So I don't think there's a uniform answer there.
And James David, that was what word you used? Community property. Is that what that is? It's
there's two kind of systems for marital property. One where everything basically gets merged, and the other where things kind of stay separate. To drastically oversimplify it, and each state kind of picks one or uses one, but it does vary based on which state you're in as to the rules.
And so just quick rule of thumb, if a person is in in the category of state where it's more community property and everything's merged, spouse's assets are more likely to be subject to the personal guarantee than if you're in the other kind of state.
I would assume that, but realistically, if your spouse isn't on board with all of this, this may not be the right thing anyway. So,
But yeah.
Can I ask a quick balloon payment question?
Yep,
sure.
Before we move on. Great. So, this is not an uncommon feature. So let's take an example of, like you said, amortized at a rate of 10 years, but a balloon payment at year 5, a seller note. What do most buyers think they're going to do at year 5? That they've just had the discipline to set aside half the balance to pay out at year 5? I mean, they must, or do they expect to refinance at that time? Kind of like the real estate game where you're perpetually refinancing sort of thing.
Yeah.
What's the game?
A lot of people will plan to refi. Frankly, a lot of times we're not talking about a massive amount of money either by the time it gets to that point. So it often wouldn't be a huge cash crunch anyway.
Yeah.
If you think about it, if you did a 10% seller note And let's say you bought a business for 5 times EBITDA, 10% seller note, you've already paid down some of it. You know, that's half a turn of EBITDA in the bullet payment if you didn't pay it off at all. So you're actually not in that much of a cash crunch situation, as you might expect. And if you reasonably plan for it, you should be able to do it.
Great point. And by the way, bullet and balloon, same thing, used interchangeably. Bullet payment, balloon payment, right? Yeah.
Yeah. And the difference, by the way, is like amortized is like, think about a mortgage where you're paying the same amount, but some of it's principal, some of it's interest, and you're paying out over time. That's amortization. Bullet or balloon payment is like, this is more common in other types of financing where you're paying just interest or some combination of interest and principal, and then boom, you're just making all the remaining principal payment all at once.
Yeah.
You pay it all off in a bullet.
Okay. Thanks, guys.
Yeah. And then another thing that comes up in SBA transactions is, you know, if the business that you're buying has, you know, leases an office or leases a warehouse or whatever, right? There's sort of a guideline that the SBA lender will, you know, SBA wants you to have at least options to get a lease to cover the whole term of the loan. These get structured kind of creatively because landlords don't necessarily want to lock in a 10-year lease now. But I will say that this is a guideline, so there can be some flexibility. I have one right now actually where we're going to get flexible with the bank on the lease term, but just know that you are going to need to have a lease in place as part of an SBA finance deal, or the bank's not going to be okay with it. So.
And I will just point out, this is one of the things that can be a footfall. I've seen situations where everything has gone well, QOE has gone well, everything else, but the landlord wasn't contacted at the beginning of the process and comes in at the 11th hour. They assume that everything's going to be fine, and the landlord decides to blow everything up. So this is one of those things that you want to make sure you do early, because the last thing you want is to pay all this money and then have the landlord be intransigent and then kill the deal at the 11th hour. So just keep that in mind. Doesn't happen often, but it really sucks when it does. The next thing is just the post-closing seller involvement. So the rule under the SBA is basically that if the seller does not retain equity, they have to be out after 12 months. So sometimes people will say, well, I like this guy, he wants to stay on, he or she wants to have a consulting role, wants to have some type of advisory role. And the answer is that if they're not retaining equity, then they can't have formal involvement beyond 12 months at the closing, because that's a violation of the SBA rules.
Guys, got more PG questions.
Okay.
Can we?
Sure.
Got a ton of them, actually, but we're not going to do all of them. Interesting question here. From the lender's perspective, the collateral that they want to see on a business, is that at all correlated to my assets? So let's say I'm buying $1 million business, and the SBA loan is 800,000. Are they looking for me to have assets equivalent to 800,000, or, what the government guarantees, the 75% of that SBA loan? Is there any correlation to what my net worth is and how tight the underwriting might be?
Yeah, not necessarily. And some of it, when it comes to collateral and what gets collateralized, some things are guidelines, some things are regulations, some things are requirements. So I guess to whether your house gets collateralized for this loan, like in certain situations, it's a must. In certain situations, it's almost always, but you have some wiggle room, right? And it gets very technical based on numbers and what you own, and the regulations are frankly obnoxious to read. But exit.
Another thing to keep in mind is that SBA lenders are cash flow lenders in general, as opposed to asset-based lenders. Rarely is there a situation where there's a lot of assets. It can happen, but it's mostly based on cash flows. And so I would say that most of the time, the underwriting is going to look at the underlying cash flow of the asset, the business. And where your assets can really come into play is if the SBA is not very convinced at the cash flow of the business and is therefore looking to see what other assets they might be able to grab. Query if you're in that situation, the SBA is kind of signaling that they're not, or sorry, the lender is signaling that they're not having much confidence in the underlying cash flow. And so if they're requiring you to put in a lot of collateral, that's also kind of an indication that they don't feel very confident about the underlying business. So we don't see it happening very often because it's almost always the case that you're looking at, how good is the business? Does the business support the loan on a cash flow perspective? Like that's usually the conversations that people are having.
You'll also, where your own personal assets play a role similar but different to what you just said, Bill, is if the business has working capital needs, lenders might not want to see you completely dump every dime that you have into the acquisition of the business and know that you have some of your own personal dry powder to help with working capital if it comes to that. Similar but different.
Yeah.
Pretty technical question here, but an interesting one. If a buyer prepays or either their SBA loan or their seller note, do they have to pay all of the interest, the full period of amortization, or just up to the point that they're prepaying at?
If you make a balloon payment, you'll be paying everything in full, principal and interest, and then that's basically the end of the note.
Yeah. And what about the case where you happen to prepay? So prepay versus bullet payment. You're actually able to pay faster than you had agreed to.
Same thing. It's possible that some loans have a prepay penalty or a prepay additional payment, right? But it's same thing. You'd be paying it off in full.
Yeah, and the answer is that most of the time you're just paying the principal off. But in seller financing, that's always the case. And I believe that's mostly the case in SBA land. I could double check, but you're also have the ability to refinance after a couple of years. So one neat trick, something you guys actually should know about, is that a lot of times after 2 years of business operating history, you can refinance from your original SBA 7A loan into a loan that is, 2% lower. Something a lot of borrowers don't pay attention to, and then you can just do the new principal, and you're not going to have a prepayment penalty, and in fact, it'll pay for itself very quickly. So just something to keep in mind.
Okay, thanks, guys. So many questions coming in, but I'll let you keep going.
All right. So now we're going to talk about briefly and I know this is a lot of text, but this is the formal name for this new program. Trust government people to come up with a crazy name. So we're talking about, this is the new structure that allows there to be a seller role and an asset purchase, right? This came into effect, I think, in December, so it's only about 3 or 4 months old now. It used to be, a year and a half ago, that you had to buy the seller out completely. Then there was a new regime where you could have a seller role of equity, but those all had to be stock purchases. Now, as of a few months ago, it's now possible through what is formally called a multi-step partial change of ownership. That's a mouthful. To do an asset purchase where you create a new entity, you create an entity that will purchase all the assets of the target of the business, and the seller will end up with a percentage equity interest in the new entity that you have created. So it gives you the benefit as the buyer of doing an asset purchase, so you get all the tax benefits of that. But it also allows you to get all the benefits of doing a seller equity roll. It's something that we have seen quite a bit of now. I'm just this morning even submitted one to a lender on behalf of somebody where we're trying to restructure an LOI to use this new possibility. Just because of how beneficial it is. It's also possible, if you structure it correctly, to get that seller roll to be a tax-free transaction for the seller. So, but that has to be done in the proper way. This is a sort of structure that outside of the SBA has been very common for quite a while. But it's a real game changer in the SBA context, and we think, frankly, it's going to be something that a lot of people want to take advantage of. But I will say, since it is new, lenders are still getting used to it. And so some lenders are still very cautious about it. But others have, I think, jumped in with 2 feet and are full on embracing it. So,
Can you plug any lenders that are full on embracing it, James David? Offhand, do you know?
yeah, I'm not gonna necessarily do that because I don't know. But I would think, just think of the usual suspects.
Yeah,
Okay.
I could say we've talked to several top lenders in this space that you guys have had on your program, and they're happily going forward with the new program. I've already done loans under that. So any of the people that are really well known in the SBA space, I think, are going to be there.
And
And
under this program, it does change. There are slight tweaks to even the equity injection requirements are a little bit different for some of these loans. So like some of the technical things do change. This is also a great way. I think the way it's written in the SBA announcement that announced this is really this was and I think will be used to let employees to let owners sell to employees. I think is kind of what this was maybe intended to, but it does allow much more than that. Where if you do go with this route, one thing that's going to be much more important to negotiate now is, okay, so you have a seller post-closing who has say 15% of the business. Okay, well, ideally, not always, but it's possible that you would want to negotiate sort of a second exit, right, for that seller, right? What happens for that extra 15%? Is the seller just supposed to keep that in perpetuity? Is there sort of an expectation that you're going to buy them out after a couple of years? Do you want to give the seller that option? There's a lot of room for negotiation there. But if you are going to go this route, it's probably best to go ahead and try to sort some of those things out in advance if you can.
Guys, got a couple questions on that refinancing after a couple years technique you mentioned.
Mhm.
So I'm going to consolidate a couple of these questions. Can you just kind of elaborate on that? And then specifically, does the PG go away if you do that? Can you get into a loan product that doesn't have a PG? Is the new loan product another but different SBA loan?
So the new loan product is just a commercial loan from just a regular commercial lender. Whether there's going to be a PG, not always. I think it would be one of the things that could be negotiated. But you do need a couple of years of operating history for commercial bank to be okay doing that.
And I would say also, this is something where you can feel free to reach out to us if you are in the situation where you do that. We have lots of lenders that are happy to to talk to people in these situations. And so, you know, if you do have specific questions or this is applicable to you, you know, do feel free to reach out, because we're more than happy to provide, you know, any introductions and, you know, get a sense of the terms and more details there.
Great, guys. And the new multi-step rule, somebody's asking, does that mean that you can effectively structure earnouts with SBA loans?
Not, I mean, you're still under similar constraints, in the sense that it's not going to be a straight earnout. Now you could probably get creative in the operating agreement, right? Where the buyout that you pay in the operating agreement for the remaining seller might be dependent on the performance of the company post-closing. So on the margins, it will make it a little easier to do that type of structuring. But fundamentally, you're still living within the constraints. It's not that you can just put a straight earnout into the purchase agreement. That's still, you know, basically not allowed.
Yeah. So you can get closer to an earnout, but it's still not a, you know, traditional private equity earnout style.
Yeah. All right. Well,
you.
I think, gonna go on to pari passu lending. So this is a word in French which means on the same footing. Didn't know you're gonna learn French today. Basically what this is sometimes, so the SBA 7A loan is capped at $5 million, and sometimes you'll want to reach a little beyond that, and you might have a, you know, $1 million gap that you want to fill. Some lenders, not all SBA lenders, but some SBA lenders are willing to fill that gap, but you go through a much more extensive underwriting process because they're not government guaranteed. Keep in mind, the 7A program is, you know, mostly government guaranteed, which is why lenders are willing to do it. But the additional piece, you know, is not going to be government guaranteed, which means that the lenders are going to be a lot more careful about who they lend to. And that's also why, you know, not every lender is going to offer this. But keep in mind that if you're finding yourself going a little bit above that 5 million cap, the right lender will possibly be able to provide you additional debt financing on the same terms.
But they are going to do more extensive diligence on you as the operator and on the business, right? Because the pari passu part of the loan is just a normal commercial loan, but they have to be on the same terms as the SBA, and that's per SBA requirements. So it's effectively them becoming a junior lender without any of the benefits of being a junior lender, which is why there aren't that many banks that do it. But, you know, if you're targeting a deal size, total EV, maybe 8 million, 10 million, right? You know, it's possible to crib together a cap table with a seller note, some equity, 7A, and maybe you've got a little bit of gap, right, as Bill said. And then this is where the pari passu program would, or pari passu loan would come into play. So if you're under the SBA cap, don't worry about this part. But if you are above the SBA cap, this is a possibility.
Do you guys feel like people should therefore go out looking for a $8 million business? No, right? I feel like it's kind of, when I've heard of pari passu situations, it's kind of, they didn't set out to buy a bigger business. They found one and then tried to kind of piece something together, and pari passu helped.
That's much more common. And it's also, right, just the pool of searchers who could get this is smaller, right? This is you're probably talking about people with plenty of industry experience and background, right, to be able to take advantage of one of these products. But yeah, it's not common that people set out, it's like, yeah, I'm looking for an 8 million. No, it just happens sometimes that you find business, right? As I always say, searcher or sponsor business match is the most important thing. So, yeah. optimize for that. And then if the target ends up being a little bit bigger, this is one of the potential tools in the toolkit.
Yeah.
And I think it's one of those things where it's like, don't let the tail wag the dog. I mean, your decision on which business to buy should be based on the fundamentals, and then often you'll find a way to make the financing work. You know, it's not that you should start with a financing idea in mind and like work backwards. That's just, you know, probably not the best approach.
Great point.
So now we're going to talk a little bit about traditional debt financing. So we're outside of the land of the SBA, and now the real benefit is the sky's the limit, right? As for basically any deal size that you'd be willing to do, there's debt that's there to finance it. This comes with costs. So a lot of times if you're in independent sponsor land, you're not going to be using you're not going to be using SBA debt. You're going to be using traditional debt financing. Unlike an SBA land where you can use, you know, combined with seller financing, 90% leverage, you're just not going to get that type of leverage in traditional debt financing. Usually the debt finance piece is going to come out to maybe 50% of the overall, you know, purchase value. And so don't expect to get to the higher multiples. And it's also the case that these loans are higher interest, and you're also paid over a shorter period of time. Think 3, 4, 5 years, as opposed to SBA, where you're usually paying that over 10 years. So this is much more, and often they'll basically have requirements that any excess cash that you produce is swept into repaying the loan. So there's much more of a pressure to get the loan paid off. And so you should know that you're going to be much more constrained than you would be in an SBA process.
Yeah. So these loans, you know, SBA loans for all of the personal guarantee and all of the requirements in the process, right? SBA loans are very covenant light, right? There are very few things you have to do as the debtor kind of on an ongoing basis other than make payments, right? Then the traditional debt financing, you know, there may not be the personal guarantee, but you have a lot more covenants, and these can be heavily negotiated, right? So as what Bill mentioned, right, excess cash flow, right, above a certain sort of profit margin or whatever metric is chosen, right, just automatically goes to paying the loan. There could be requirements for audited financials. They get sent to the lender on a, you know, fill in the blank quarterly basis. If you have things like that in your loans, you do need to make sure that you actually do those things, right? A technical default, even of one of these loans, and potentially your lender could accelerate the full balance on you, right? So if you do have these covenants in loan agreements, they matter and you need to abide by them. The fees are different. It's not unusual if you are in this situation to have a debt stack in addition to an equity stack, right? You could have a senior lender and, you know, one or more, you know, mezzanine lenders who are junior to that. And the terms of each of those loans is going to be different, right? The interest rates, for example, are going to get higher the further down the priority stack you go. But, you know, we were sell side on a recent deal where I think they had 3 different debt providers on that one, in addition to all the equity partners. So, you know, it's not unusual for something like that. It makes it a little bit complicated for us to manage all those processes, but, you know, that's our job. So.
And another thing I'll just mention is that unlike with SBA loans, in traditional debt financing, especially in the lower part of the market where we are, it's much more common for the lender to take equity as part of their deal, as part of their upside. So they might get warrants to buy equity, you know, can be 10, 30% of the overall equity, depending. And so, you know, that's something that can come as a little bit of a surprise and something you should be aware of as you're sort of building out your model.
Guys, question about the size of deal that how realistic it might be to get conventional financing. So, the specific question from Jason in another webinar, he heard a loan broker mention that in reality, traditional conventional debt, commercial loans are likely only to be available on businesses with 3 million bucks of EBITDA and above. And so smaller than that, they're just not going to be interested. That's where SBA plays. Do you agree?
I don't know
No,
that
because
there are
we
hard rules
um,
on that, but there's also different sorts of with these conventional lenders, right? You could have asset-based lenders who don't really care what the EBITDA of the business is. Like, you got if it's a heavy, if it's a big manufacturing facility and you've got a bunch of heavy equipment, right? It could be that an asset-based lender is part of this, in which case they're judging it on completely different criteria. Bill, I cut you off. Go ahead.
Yeah, I was saying we have seen deals lower than 3 million EBITDA that have gotten financed. So it's not impossible. I will say there's this kind of weird valley, right, where SBA cuts off and traditional debt financing comes in. But if you're thinking about it, right, like if you are financing something, you're buying it at a 3 times multiple, or a 3 times multiple, then $3 million gets you to 10 million. Now, not everything's done at a 3x multiple, right? But almost naturally, you end up having this weird kind of valley at like between, call it like 6 million and 10 million, where things get a little bit weird. But we have
because 10 and 9 million, like 3 million, basically too big for SBA, too small for conventional. There's a kind of gap in the lending options there, the loan options.
Yeah. And things like the SBICs have floors. The Small Business Investment Corporation, right? They won't look at something unless it's a certain size, and that kind of varies based on each entity. But and a lot, there are lenders who won't touch it until it's a certain, right? Until the loan size is X amount, right?
Yeah.
We won't loan less than X. Well, if your gap is smaller than that, right? But their minimum loan is 5 million, but you only need 3, right? There is a gap there.
Yeah, I mean, we did a deal last year that had traditional debt financing. We were the sell side, and I believe there was 2 million EBITDA on it. So the idea of 3 million being like a hard floor, I think that's not quite accurate.
Okay. But it is directionally true that traditional debt, conventional debt, is for bigger deals.
Yes.
Because everything has to pencil.
Yeah.
And it will be difficult in that just above SBA round. It's not easy.
Yep. Thank you.
Just some general tips to kind of leave you with. So financing always takes longer than you expect. It is almost always the thing that ends up, being the final pull that you have to get across in order to get to the finish line. So do engage early. Get multiple term sheets, because sometimes a lender might have an idiosyncratic issue that takes them out of the deal, but wouldn't take other lenders out of the deal. And if you have to, if you've only been dealing with one lender and you have to pivot, that can be a bit of a problem and delay closing, and the seller can be angry at you. That's often a little bit more true in traditional debt financing. And then we already talked about life insurance issues. I just thought that would be like a public service announcement if you are dealing with guarantees. Also, just something to know, a lot of times you're required to get life insurance as part of this process. And sometimes people will wait until post-closing or other stuff to get doctor's appointments and other things. And it's just a little bit of a hassle, not something you want to be worried about when you're just starting your business. So, there are little things like that creep up, and just make sure you're getting ahead of them so that you're not scrambling at the wrong time. So. All right, well, that's basically it. I mean, we're Barlow and Williams. We're a flat fee M&A law firm. We help out with all these different transactions, and we're happy to help answer any other questions anyone has.
Great. Got some more questions, guys, which I'll turn to in just a sec. Excellent presentation, as always. Can you give us a little bit more on yourselves? You mentioned the flat fee structure. Maybe elaborate on that a little bit. Maybe just speak to your experience a little bit. I'm giving you cover to plug, sell yourselves here.
Thank you.
Give us a minute or so.
All right, well, the elevator pitch is we work on a flat fee basis on all of our transactions. So we have a discussion about your particular deal, and then we give you a quote, and we always stick to that quote. Our backgrounds is James, David, and I, we were both at Harvard Law School together. I worked up Wall Street doing private equity mergers and acquisitions. James, David was a litigator out in DC. We've been doing this together for around 4 years. And this is all we do, buy side and sell side M&A, and a lot of work with searchers. So we know the market very well. We think our pricing is very fair. It's very transparent. You know exactly what you're getting. So, we like to think that it works pretty well for all sides. So.
And that flat fee, guys, is based on you have the conversation to understand the complexity of the deal, what will be involved, and then you estimate.
Yeah, it's based on things like the size and complexity of the deal. Is there seller rollover equity? Are we dealing with outside investors in the transaction? Like those are some of the bigger things. And then mechanically, our fees work in sort of a milestone basis, and they tend to be backloaded. So that's still it's always a moving target on how we do that. But the current iteration for a typical searcher deal will have 3 milestones, right? That's the start of the engagement, which is meant to be the point at which we help you finalize the letter of intent. The point at which we'd like to be brought in to a deal is after you've sent out an LOI, maybe even the LOI template that we talked about in last month's webinar. You send that out to a seller. The seller responds. The seller redlines that agreement. Okay, now we think we have a deal. Now it's time to bring us in to finalize that and make sure everything works for whatever financing structure you're looking for. And then that works with kind of legal diligence too, is also a part of that first milestone. Then we wait on all the financial diligence and a lot of your operational diligence. Then at a certain point, there's a go, no go decision. And if you say go, deal's on, right, that's the second milestone, and we'll take an additional payment at that point. And that's when we draft whatever set of documents is needed for the transaction. And then we'll take the balance of our fees out of the loan disbursement at closing. That's how that works mechanically.
That way you're only out based on the milestones we hit. You won't be out the full amount if, for instance, the deal dies in due diligence or something along those lines.
Multiple people asked about that last month. So.
And guys, explain why flat fee aligns interests between you and searcher?
Because if you pay for time, you're going to get time. I'd rather be paid for results.
And frankly, we have there is an incentive for hourly attorneys to fight about things that might not necessarily matter for the deal and might actually put the deal at risk, and to overemphasize or inflate the importance of those things as a way of churning hours and doing all of those stuff. So the incentives just end up a little bit wonky when you do it that way.
Super. I heard you mention an LOI template. What's this LOI template, and where can I find it on your website so that I can put the link in the chat for people?
Yeah, so we did a webinar, I think it was probably 2 weeks ago, 2 or 3 weeks ago. But last month's webinar, we published an LOI template that then got shared with everyone. We have since uploaded it to our own website where you can click on a form. You click on a button and it's puts in an email for you to send to us, and then we will send it to you. So if you go to what is it? barlowwilliams.law is our website, and then hit on click on the resources tab at the top of that. Which I guess I could probably do it with a shared screen, but I'm not going to. And then you'll just click on whatever that is, the legal starting your search, and then there's a button in there.
There it is.
Okay,
everybody putting it in the chat for you. So there it is, and you can get the LOI template. Oh, and that's just a reposting of the webinar, that page as well.
That page is a reposting of the webinar with timestamps questions. We've done that with all the webinars actually, but don't want to divert traffic from you, Will. So we don't go too
Not at all, man. It looks great. I by the way, I noticed those time-stamped questions. Got to add that to my own repertoire here. Really, really helpful feature. Super. That was great, guys. So a couple people asked when you were talking about shopping your deal to various lenders about using a loan broker. I will selfishly plug a couple sponsors, but after you guys share, what you think of loan brokers as a way to approach getting multiple term sheets and shopping the deal.
I mean, I think that they can be a very good resource, especially if you're doing this for the first time. I think something else to keep in mind is that a lot of times people are focused on interest rate. And although, yes, that is an important term, that is not the only term. Certainty of closing and how often they do it is also very important. And that's where I think a loan broker might have a little bit better of an idea. Whereas, if you go to yourself to the websites, every bank that does any SBA loans is going to say, we do 1 million SBA loans. We do it all the time, whether or not it's really true that they're an expert in the space. So just kind of keep that in mind.
Great. And I'll just say, I have two separate sponsors of Acquiring Minds who are both loan brokers, both well-known names in this world. Matthias Smith, Pioneer Capital Advisory, and then Heather Enderson of Viso also. So both big SBA loan brokers. Check them out. Heather actually did an office hours last week, and she'll be doing another one in a few weeks. So you can Google those folks. Somebody saying the link that I put to your guys' website doesn't work. I just clicked it and it seems to work. So if it's not working for you for some reason, folks, barlowwilliams.law, go to resources, go to the very top link, starting your search in LOIs, and then there's the LOI template button there. Okay. Let's see.
Swimming through all the questions.
swimming through 80 some odd here. If we work with you, buyer asks, will we work definitely with one of you, or are there other folks, associates, what have you, in Barlow and Williams at the firm?
You are looking at the entirety of Barlow and Williams. It is the two of us. We do have an assistant, but there are no other attorneys, no associates. It's just us. So if you want to reach out to one of us, you think one of us is funnier or better looking than the other, you feel free to do that. Although it better be to me that you reach out if you do that. But no, when you work with us, you work with us.
Great. Do people use legal for deal structuring? Can you advise on deal structuring and I guess negotiation on terms itself, or mainly just for contracts, legal diligence? Good question.
So we definitely do advise legal structuring, and something else is just because we see such a high volume of these deals, we're closing 3 or 4 of them a month. We have a good sense of how sellers will react to different proposals and whether they'll be allergic to something or not. So, the good thing about using attorneys that really are active in this space is they can provide a lot more value besides just papering the contract that you've put together. We can help you strategically understand what the best way is to accomplish your overall business goals.
Great. At the start of the webinar, you mentioned that the length of the standby period of a seller note can impact how the seller note would count as an equity injection. Can you say more about that?
Yeah, so, and it's, although this has been in flux, at one point, there was a requirement that it had to be on standby for the full 10 years. To count as equity. I don't think that's the case anymore. And sometimes people will split the seller note into different structures in order for part of it to count as an equity injection and part of it not to. So this can get pretty granular. A fairly typical structure would be a standby for either 12 months or 2 years. 2 years probably more common. One of the kind of normal things is, amortized over 10 years, balloon payment at the end of 5 years, and full standby for the first 2. Is sort of one of the traditional, more common structures, although some of that is lender specific as to what they will accept. So it's, again, right there are SBA guidelines for some of these things, and then banks have interpretation.
And just so you know, when we say full standby, what we mean is no interest or principal payments are made during the standby period. So the seller isn't receiving anything until that 1 or 2 year standby period is done, at which time payments start. So it's additional risk for the seller since they don't get paid right away.
And sorry if you said this, guys, but also you're not accumulating, you buyer are not accumulating interest for that time.
You are accumulating interest, but you're
Yeah.
not paying interest.
You are accumulating it. So it's not like you just get to push the.
This gets negotiated, actually. Sometimes it is, sometimes it isn't.
Yeah.
Okay. Because if you were accumulating interest, then when the standby period ends, let's say after 2 years, there's a kind of a mini balloon where you've got to do a little bit of a catch up. It would be over those last 2 years. Am I thinking about this right?
No, how it's usually negotiated is whether the foregone interest will be effectively added to the principal. So it's not like you'd have a mini balloon where you pay all the interest for the previous 2 years. It would just be, does that principal increase by the amount of foregone interest that was paid during that 2 year period? And as Jim David said, it's a matter of negotiation.
Great. Okay. Can you give me details on life insurance issues and why some individuals may experience more issues than others and how it could kill the deal?
I think it's rare for life insurance to truly kill a deal. There are in traditional financing, sometimes lenders will try to collateralize a loan using life insurance. And if that's the case, then it becomes a more critical component to a deal, I would say. Otherwise, it's usually not really that, it's something you have to do, but not something that is, particularly vital. But I also just mention it because if you have significant others that will be depending on you and your life insurance policy, you're going to just want to take a look to make sure what happens with that if you die and then that goes into the estate and then you have a personal guarantee and therefore, the bank ends up taking all of it. You just want to make sure that that's all figured out if that's important for you.
Question on distributions in the early years. Distributions, so taking profits from the business in the early years. Are there ever restrictions with SBA lenders on distributions of earnings in the early years following an acquisition? If so, how often, what do you see?
So generally not. A lot of times you're going to be wanting to repay the loan as quickly as possible. So there's usually not that much. And frankly, you can kind of take it as salary anyway. It just is a tax question. There's definitely a ton of restrictions in traditional finance. The answer is no, you're never going to take it. But
with the SBA, as long as you're able to meet your minimum debt service coverage ratios, then you have much more flexibility.
Yeah. covenant light.
I've heard SBA lenders effectively say, you don't hear from us really after we do your deal, as long as that we receive your check, your loan payment, you really don't hear from us. Now, don't,
Yeah.
use that.
And-
Why that's very anecdotal. But I've heard it said, and it really is, this point about the SBA not having covenants really is a differentiator, because in traditional conventional lending land, covenants and all that, your lender looking over your shoulder is really common, is really the norm.
Yeah.
Sorry, James David, you were going to say?
No, I was just gonna say, like, that's part of the beauty of the SBA loan is, once you go through the process, painful though it may be, and it is for many people, but once you're through it, like, as long as you make the payments, everything is okay, right? It does not have these covenants or these strings, or it's just kind of additional burdens.
Great. Quality of earnings, mandatory for SBA financing?
Basically, yes.
Yeah, highly advisable. I don't.
But according to SBA rules, or do most lenders
Yeah, I think a lot of lenders are gonna kind of insist on as part of their internal process. I would have to check this, but I don't think it is a formal SBA requirement.
I will say that
go ahead and do one. Please do one.
Yeah.
Please do it, because if you don't, the risk can be catastrophic, frankly.
Yep. Bill, what you're saying?
Yeah, no, I was just reiterating that, like, even if it's not a technical requirement, good luck finding an SBA lender to underwrite without it.
Yeah. And you really should be asking yourself why you're doing it. Is it because you're an accountant who's done Q of E's for 100 other clients? Maybe, then sure. But that's not any of you. You're probably just trying to save money, and this is not where you want to save money.
No.
Okay, guys, we're at 1:04, so I'm going to wrap us up with the final obligatory crystal ball question. Doge meets SBA. Your thoughts, your predictions.
Well,
everybody's talking about it.
Yes. It's hard to imagine a government program that sounds better to both sides than small business stuff. So I think it's very unlikely that we're going to have a problem with SBA loans continuing to be given out. So I think this is something that I feel very confident it's going to be, going forward. In fact, it might be interesting to see whether they increase support for the program at some point. So
listeners have seen the tweet by Elon saying that 8% of loans are paid back or something. Only 8% of SBA loans are paid back. And the now understanding is that he was just referring to PPP loans, which were effectively grants, always were that way. And so it was poor naming, I guess, on the part of the SBA. But so who knows what goes on in the mind of Elon Musk? But one would have to think that when and if he or Doge looks closely at the success of the SBA 7A program, they won't see a wasteful program. So in fact, it's, according to what I always hear, haven't verified this myself, but it's it pays for itself. So that's pretty compelling.
Yeah.
Fantastic, guys. Anything else you want to leave us with? We got all of everything there. Any last thoughts before I shut us off?
No, just feel free to reach out on our website. We're always happy to have a call, and yeah, good luck on your search.
Fantastic. James David and Bill will be back again for an office hours next month. They are the legal office hours, monthly legal office hours for Acquiring Minds. So keep your eyes peeled for their next sesh, and go to their website or Acquiring Minds webinars, and you can see all of their past sessions if you missed the links that I put into the chat earlier. But just an amazing amount of really great counsel in those webinars. Check it out. And this is being recorded, and we will be sending out the recording here in the next day or two. So thank you everyone for coming to the webinar. Thank you especially to James, David, and Bill. This concludes the webinar.